The nearly 10% market sell off is touching nearly every company on the market, but institutions are dropping out of some stocks more than others. Here to break down his list of 3 companies institutions are quietly selling is MarketBeat analyst Gabriel Osorio-Mazilli. Gabriel, let's start off with this market sell off. It's been quite a tumble over the last month.
Right. This is something that nobody was expecting, especially in the first quarter of the year, which is always the most important as it sets the tone for the rest of the entire period. This one could be blamed on a couple of things. First, the Fed's measure of GDP growth has swung into a negative expectation for GDP for the first quarter. And as you know, GDP is a reflection of the stock market and vice versa. So where GDP goes, the stock market goes. So with this negative territory looming around for the first quarter, it makes sense to see the S&P sell off, as you said, nearly 10% over the past month. More than that, we also have declining retail sales data, which I think is why institutions chose to go into the consumer discretionary and retail sector to start their dumping ahead of everything else.
Yeah, let's get right into your list of those 3 companies that institutions are specifically dumping right now. And it does seem to be really geared toward one sector in particular.
Right, so the first name in my list is not a single stock, but a combination of all retail stocks in the XLY, which is the Consumer Discretionary Select Fund. This is an ETF that investors can have access to when they want to express review on the retail and discretionary sector. And this is something that institutions have been dumping over the past quarter. Now, when you collect the data as of the last month, we had the retail sales data pull back at the most aggressive pace since 2022. That means consumers are not going to be spending, earnings won't be that pretty for the first quarter in these stocks, and it makes sense to see institutions pull back in the broader exposure ETF before jumping into anything individually.
Let's look into exactly how much institutions are selling off this retail ETF.
Right, so as of the past quarter, the institutional holding data shows up to $3.5 billion being sold out of this ETF. Now, the leaders in this sell off are coming from Northern Trust, the largest holders in the ETF. What investors can assume from this or take away from this is the leaders in the ETF, the ones that hold the most, are pulling out first. And as they say in the stock market, there's only one exit. When everybody wants to exit the theater, it becomes a bottleneck. So when you see those type of institutions exit first, it means something bigger might be underway.
Yeah, that's important advice for investors to pay attention to, and exactly why we wanted to do this video today. And this ETF is really more of an industry, but which companies make up the bulk of this ETF?
Well, I would say the top 5 are the most important here, and leading the way is Amazon. So who is better to gauge the consumer sentiment today other than Amazon? It's really at the pulse of the American consumerism and activity in the economy today. By selling out of the ETF, this institution, Northern Trust, is basically saying they've lost confidence on Amazon as well. Might not be a sign to sell or short the stock even, but it is a sign of start taking some chips off the table in this way. The next 4 stocks in this list are Tesla, Home Depot, McDonald's, and Booking, all exposed to the same consumer discretionary sector that we've been speaking about and that trends in slowing consumer demand.
Yeah, some of the same reasons why investors would follow what institutions are dumping out of right now is the same reasons they like to look at what corporate insiders are selling too. You can find all of those details in our latest report on 12 stocks corporate insiders are abandoning. You can scan the QR code or click the link in the description of this video to get that free report on marketbeat.com right now. Let's move on to the next stock that you have as a company that institutions are dropping out of quickly right now.
The next company in this list is Progressive, the insurance carrier that everyone knows and loves, except for these institutions that have been selling lately. And there's a couple of reasons for it. First, lower inflation expectations, as the one that we just got this week. A lower CPI means a couple of things. Lower spending, which we already know, but also less buying of vehicles, of homes, and the sort of products that Progressive insures in the first place. Second, lower inflation has a direct impact on how much premiums Progressive can charge, as inflation drives up the year-on-year change of the premiums that we all pay. So it makes sense to see Wall Street analysts see a 50% decline on the quarterly earnings per share forecast for a progressive company. So, as you know, where EPS goes, so does the stock price.
Let's talk about how much of a sell-off institutions are having right now in Progressive.
Same as the XLY ETF for consumer discretionary, the leaders, this time Janus Henderson, dropped their stake by 2.2%. Now, again, being the largest holder and being the first ones to get out of the stock before anything else happens, they're looking to get out while there's still liquidity in the market, while there's still investors in the stock, because when the news break out and if the potential sell-off keeps on coming, they're not going to be able to get out as easy or as quickly.
Thanks for sharing that second pick, Gabriel. Now let's move on to the third company you see a lot of institutions selling right now.
Think about this. If insurance spending in the economy is going to go down, what about other non-essential items like traveling? And that is why I focused on Booking.com. Its stock, well, it's gotten $210 billion worth of outflows from institutions in the past quarter. Connecting the dots, you can also see that Wall Street analysts see a 50% decline in EPS over the next quarter. Same as Progressive, but I think this one has a lot more downside to it, given how much more cyclical and how much more higher of a beta it carries next to a more stable or safer name like Progressive.
Absolutely. And that is a huge sell-off for a pretty big industry that recently has had quite a good year. In fact, travel has had a good few years in a row with a lot of demand in the travel sector. How quickly do you think that shift could come, seeing some of the big sell-off that we've seen so far?
Well, that shift that you mentioned might already be here, as you see the numbers trending toward business class travel, business related travel, and premium travel rather than leisure and economy travel. Traveling is one of the first discretionary items that get cut out of budgets and tougher economic environments like today.
I feel like this whole list that you've given today is kind of a sign of a low consumer confidence in wanting to spend those discretionary dollars right now, whether it's buying a new vehicle, buying something off of Amazon, or booking that next big trip. Is this whole list of stocks and companies that institutions are dropping out of right now a larger sign toward what we might expect in the economy to come?
When you take into account where consumer credit is, you see credit cards being at an all-time high and delinquencies following as well. I don't think that consumer spending can hold out much longer, which is why you start seeing data from the past month slowing. You see price gauges through the CPI and business side as well, the PCE, slowing as well. So there's a lot less demand year on year, quarter on quarter from both businesses and consumers. So when you zoom out, I think that this is a trend going in the wrong direction, unless the Fed or the administration right now could do something about it to switch us back to a heating economy.
Some really good information for investors to consider today, Gabriel. Thank you so much for your time. And thank you for joining us here on MarketBeat. Check out some of our other content here on our channel too, and let us know what you think about these companies that institutions are dumping right now, and whether you're holding on or letting go of them in your own portfolio. Thanks again for watching. And as always, happy investing.